Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights, the multifamily and marketing show. I'm your host, John Kasman, and I want to thank you for joining us for what's going to be another great, exciting episode. Now, if you have been enjoying this show, you have to do me a quick favor and leave us a 5-star rating and review. And if you haven't already, make sure you hit the subscribe button so you don't miss an episode. Now, today we're going to be talking to Mike Vann. Mike has been investing in real estate for almost 20 years throughout Arkansas and Missouri while balancing a family and a full-time career in the medical device industry. Now, he built a $6 million plus personal portfolio across multiple asset classes consisting of single-family, small multifamily apartments, and commercial properties. Now, since then, he has really been focusing on achieving his goals through apartment syndication and has been involved in the purchase of approximately 1,000 units in Kansas, Oklahoma, and DFW, valued in excess of $60 million. Let's welcome to the show, Mike Vann.
Hey, John, thanks for having me.
Mike, thank you for coming on the show. I went over your bio at a high level, but why don't you take 30 to 60 seconds and fill in our listeners a little bit more on who you are?
Well, like I said, thanks for having me on the show. My name is Mike Vann, and as you pointed out in my bio, I've been investing in real estate for almost 20 years now. Started out just like most everyone else, small multifamily, single family houses. I've done flips, lease purchase, the whole thing. And then after going through a couple of layoffs successfully, by the way, through my day job, realized that I needed to scale and make sure that that was not going to leave me holding the bag at some point in the future. So I decided to get into multifamily syndication and help educate others as to why I do what I do.
You said getting through a couple of layoffs successfully. Explain what that means. Were you laid off successfully or did you avoid layoffs?
No, I avoided layoffs.
Okay.
But the stress associated with waiting for that phone call is something that I don't ever want to experience again.
Listen, I completely understand. For our listeners who understand my story, you guys know I was at General Motors back in 2008, 2009. And when we were going through that period, it was brutal. And, I actually did well, but like you, I successfully navigated it. But it felt like every day that pressure or that concern was there. And, for us, unfortunately, I had to, turn on the TV and I could see it just as bad as, feeling the pressure internally. So I felt like I couldn't escape it. So I completely understand where your head's at. And you said for you, while you're building your small portfolio, small multifamilies, single families, and doing other things, you started transition into syndication, especially to help other people as well. What was it exactly that you found appealing about syndication and what made you decide to go down that route?
Well, fortunately and unfortunately, in the medical device field, I've been blessed to have, a good income, and being able to replace that income takes a lot. And although my personal portfolio is doing okay, it wasn't enough to get me where I needed to be to make my wife feel comfortable with me leaving my job yet. Not to mention I have 2 kids that are going into college. And so that's another level there. So, I had a lot of people asking me about investing with me over the years, physicians I work with, other friends and family that I've known. I've been doing this for a long time. They ask me questions. They, talk about investing with me, and I've never been one that considered partners. But after so many years, of doing this and deciding that I needed to get where I needed to be from an income standpoint to be able to leave my day job and focus more on things that really matter, family and mission work, that scaling through syndication was an avenue that's going to be able to get me there. And so that's what brought me there.
Yeah, I love listening to you talk about it because I think that realization of kind of your purpose and what was really important to you. You talked about family, your mission work. For those who don't know, I'll give a little bit of a quick backstory. We were actually supposed to court this last week, and you had some mission work that kind of popped up that you needed to take care of. So we're doing this now, and I think that just goes to the core and kind of the point you're getting at. Syndication. I think some folks have. A misunderstanding of what it's really about. This is really about pooling together resources to make it easier for people to take advantage of the benefits that come with multifamily investing, real estate in general, multifamily specifically, as opposed to everyone trying to go out there and do it all by themselves. And that's really the benefit because everyone doesn't want to take the time and invest the 20 years that you put in learning about all the different strategies and how to do things and what works and what doesn't work. Some folks really just want to spend time with their family and doing the things that matter in this world, making an impact on their family, their friends, their causes, their community. And multifamily syndication is a great way for people to do that passively. Now, you mentioned that you really didn't want to get into partnerships and it wasn't really the way you were thinking about it. And something kind of triggered to make that transition. What was it like when you finally made that decision to say, you know what? I want to get into multifamily syndication. I'm going to bring in some of the folks who keep asking me or talking to me about investing. What was that like? And how did those first handful of conversations, what were they like when you started to talk to people about what multifamily syndication was and passively investing?
Well, because I've been in this a long time and have had those conversations over a number of years about real estate investing in general and the benefits and things like that. The people that I had the initial investment conversations with were happy. They were like, "Oh, finally, I get to do a deal with you," and realize some of the benefits that you've been telling me about all these years. But beyond the initial friends and family, the conversations I had with other folks that I knew were more on the fringe as far as their level of sophistication in regards to real estate investing, were a little bit more difficult and a lot more educational. I love to talk real estate. I love to teach people about real estate. I love to share the reasons why I do it to get them excited about it as well, because there's so many benefits that people don't even realize, about real estate investing with the tax benefits and passive income, things of that nature. So the education aspect is something that I actually liked about recruiting new investors. So yeah, the conversations were fun. Actually, I didn't view it as asking people for money. I viewed it as giving them an opportunity.
No, I love that. There are three things you said that are pretty powerful to me. First and foremost, you were talking to people about real estate even before you had any idea or dreams or visions of trying to partner or get investors from it, right? It was just a passion, something you were doing, something you enjoyed. And I think that authenticity is what gets people excited, because if you're having fun doing something and it's working well for you, you're going to share that, I mean, it's just like anything else. If you love surfing or playing golf,
Right.
you're going to tell people about what you're doing, and that's kind of how it started. So it's very organic and natural for some of those initial investors to say, hey man, you've been telling me about this for years. Of course I'm interested in learning more about it and investing potentially. But there's a second group where they weren't quite as knowledgeable about it, and you had to spend more time educating people and focusing on the education versus asking them to invest. I think that's a very powerful insight, because if people don't know what you're talking about or they don't understand it, they're not going to be ready to invest because they're confused, and confused people don't invest. So focusing on the education piece, I think, is a smart way to get those individuals comfortable, let them learn more. And if it's a fit for them, great. If not, so what? Because it's an opportunity, which is the third thing you said. You weren't going for a sales pitch or anything like that. You were presenting an opportunity that had given you a lot of value and had worked well for you. You were sharing that same opportunity with others. And I think when you come from that perspective, you're very empowered because you're sharing a true opportunity. And that's the way you see it, versus feeling like, hey, I need to go raise $1,000,000. How many people do I need to go ask to try to get this $1,000,000? I think that puts a lot of pressure on yourself. You're coming from a place of need and not really a place of service. And it becomes very, very difficult to do that. So 3 very powerful insights you just gave in that short story there. Let me ask you this. When it comes to the education piece with some of those friends and family that you were talking to, what were some of the questions or some of the challenges that you really didn't anticipate that people had?
Well, the biggest question everybody has is can I lose my money? And, that's a reality. I mean, it is with any investment opportunity. Real estate is no different. But you have to educate them as to, yes, that is a possibility, but here are the reasons why we're going to mitigate that risk as good as possible, and educate them to those different things, and just explain the business plan and your rationale behind it. It's probably the easiest way to help navigate that question. And as far as other questions, some people really want to get in the weeds as far as the business plan and what you're going to do and how you're going to, raise the rent and all that kind of stuff. And some people are just like, just give me my 10% and I'm good, So it depending on the level of sophistication of the investor, is really depends on what questions you get. And, you talked about something earlier, as far as educating investors. I really want my investor to be educated as to what we're doing, to know, I don't want just someone giving me money blindly. Oh yeah, I trust you, Mike. You're a good guy. I want them to know what they're getting into and understand the potential upside and downside, because there's nothing worse than if something isn't going the way you anticipated, to have to go back and have that conversation then, to educate them on why they should have been more worried to begin with, or at least, had that in the back of their mind that it was a possibility. But, so educating people on the front end as to what they're getting into, the potential upsides as well as the potential downsides is very important.
No, that's excellent, man. And I think focusing on both, that makes you transparent and trustworthy when you're telling them, hey, don't just focus on how much money you can make. I also want you to understand, here are the things that could potentially go wrong. Here's what we're doing to mitigate those risks as best as we can. And, here's our plan. If we face one of these situations, here's what will happen. Here's how we're going to navigate it. And here's what we're going to do. I mean, take right now, as we're recording this, we're still in kind of COVID-19. Hopefully by the time this is out, we are, the cities and states have been either opened or they're starting to work towards that. But obviously, this is something that many investors did not anticipate. So this is one of those things that, could impact a lot of investors and their returns and the potential returns that they have. How have you kind of navigated this situation, and what conversations are you having with your investors right now about the impact of COVID-19 to their investment?
Yeah, I think everybody was knew that there was a correction coming, but no one anticipated it being through this avenue. But yeah, it's we immediately got on top of it. We try to be very transparent with our investors as to what's going on the properties. But yeah, we sent out a letter immediately to our investors talking about the measures we're taking from a resource standpoint for our on-site staff and our residents. We want them to be able to stay safe first and foremost, and then also have the resources available to them to put food on the table, because a lot of people, as you are well aware, are losing their jobs or being laid off temporarily or so forth. And that leads to a level of anxiety that no one wants. So yeah, we communicate that to the investors as far as what we're doing with our on-site staff and with our residents from a safety and standpoint, as well as a resource standpoint to help them financially.
Yeah, that communication is key. I mean, to make sure you're staying on top of it with both your investors and, the residents, and trying to keep everybody safe and healthy first and foremost is obviously the number one priority. But I think beyond that, this is a relationship business, and your investors trust you, and they're not going to know every single nuance of detail that needs to take place. So making sure that you're on top of it and they're hearing from you is definitely a great way to stand out and continue to earn their trust on a day-to-day basis. So Mike, we kind of talked about, your portfolio, I think close to 1,000 units in Oklahoma, I believe Kansas, as well as DFW. Let's talk a little bit about your markets and kind of your investing philosophy right now. First and foremost, let's start with the markets. Why those three markets right now? Oklahoma, DFW, and I believe you said Kansas.
So my partners, Carl Supercrop and Rodney Miller. Carl lives in Dallas and Rodney lives in Oklahoma City, and I live in Springfield, Missouri. So we kind of invest in what we call the Mid-South. it's this corridor between where we all live that we can get to within a 3-hour drive basically to any of these markets. And we like them simply because they're all landlord friendly states. They have good solid market fundamentals. They're not the LAs or the San Frans of the world, but they're good, steady cash flow markets. And cash flow is something that we invest for, not speculation. Although forced appreciation is part of our business plan, we invest for cash flow from day one, and these markets provide that.
What are you seeing as far as population trends? What are the other metrics you look for specifically in those markets to say this one's a good market, but maybe this neighboring city is not?
Mm-hmm. So we look for the same fundamentals most people do, regardless of market, is increasing job growth, increasing population growth, increasing income growth. And in the submarkets, we look for high median household income, not average household income, but median household income, and low crime, good schools, all the places that we would want to live if we were in our residents' shoes. And from an investor standpoint, all the places we would want to invest if we were them.
Do you have a specific cutoff on the median household income?
We like it to be at least around 45,000.
And what's the rationale on that?
Because the rents that we have here, we have a 3-to-1 rent ratio for our tenants, our residents, and that more than covers that and leaves a little bit left over for disposable income.
So 3-to-1, when you say 3-to-1 rent ratio, you're saying that the residents need to earn 3 times the amount of rent. So if you're at $45,000 household income for the median, assuming 15,000 on the high end, right, is kind of the max of the rent. 3 times that is 45K, and probably even more there. You're saying essentially that makes sure that you have a strong renter pool of participants to select from if you are going to push rents and have a value add strategy, versus if it were, say, $30,000, it may be much harder to find somebody who can afford the adjusted rents that you guys are going to be implementing.
Absolutely.
Got it. That makes sense. That's a very smart way to think about it. We do the same thing, and certainly implore other people to think about it that way. I know a lot of folks will look at, lower class markets or sub markets, and there's nothing wrong with the strategy. I see people crush it with every strategy out there.
Sure.
I also see people make mistakes with every strategy out there. And the thing is, if you're going to do a value add strategy, you really have to make sure that people can afford the rents that you are that you're forecasting in the future. And you have to understand the elasticity of the market, what the competition is, all those different factors play a role in it. And, having kind of that initial number to say, hey, look, if it's the area's household income is less than this, our business plan probably won't work. That saves you a lot of time, just so you're not analyzing every single deal that comes across your desk. So it's a smart way to think about it. Mike, what are you guys working on right now? We talked a little about COVID-19 and kind of the current implications from an investor standpoint. Has that made you think about your strategy and caused you to shift anything, or how are you guys looking at your strategy as you go forward?
So, right now we are evaluating potential opportunities that are coming on the backside of this crisis. Like I said, everybody was waiting for a market correction of one sort or another. No one knew how it was going to come. Definitely didn't anticipate this, but as with any market correction, there are going to be opportunities on the backside of it. So we're currently just trying to educate our investors as to what these potential opportunities may come, and get them prepared to take to be opportunistic and take advantage of these opportunities. Not only in the markets that we're already invested in, but in some potential outlying markets as well.
Listen, and I think that's it's interesting because there are people who are reacting very differently right now, and I know that when times get uncertain, the natural reaction is to be fearful and maybe operate more conservatively. And what I would say is this is a really great opportunity. And I hate to this is not to be predatory or anything like that, But the reality is, as an investor, you want to invest when things are on sale. I think of this, and this may be a controversial analogy, but think about toilet paper. Okay. I mean, think about the craziness that just happened with toilet paper.
Right.
The people who don't understand it don't understand how important toilet paper is. Okay. It is a necessity, and it's the one reason I would leave the house. I have enough food. It may not be the meals that I really want to make, but I have enough cans in there to probably last 3 weeks if I want to just eat whatever I have in my home. Right.
Right.
Toilet paper, on the other hand, listen, everybody at home, 3 toilets, four people every day. That's just a lot. That's a lot. You're going to need your toilet paper. But the point is this: you are always buying toilet paper. You're going to buy it if it's on sale. That's great. You might stock up. If it's not on sale, you're still going to buy it because you need it. So you just buy what you need, right? And I think real estate investing is a similar thing. It doesn't mean that you don't invest when the market's hot. It means you're more selective. You maybe only buy a couple things that really look great. But if there's an opportunity, if prices are low, if things are on sale, you may want to stock up. And I think we're getting into a time frame where it may be ideal to bulk up, just like those people going to Costco and loading up their carts with toilet paper. It may be a great time to start loading up your cart with investment real estate, particularly apartment buildings. So that's the way I think the folks who are going to thrive coming out of this on the back end, they're thinking about it like that person running to Costco with 3 carts, stocking up on that TP. And I think that may be something you should think about as well as an investor.
Right. I mean, you look at, the one of the number one rules in investing is buy low and sell high. If you have an opportunity to buy low, which is going to be coming, you better be well positioned to do that. And that's another reason we were looking. We just had a strategy visioning call, earlier this week, and we were discussing, the retail investor rate versus the institutional capital rate, and exploring moving into some of the institutional capital routes to be able to take a better advantage of the opportunities that may be coming here in the next 6 months by being able to scale not only the number of deals we're doing simultaneously, but also the size of the deals we're doing. And we felt that adding that institutional leg to the capital track may help us in that regard.
Yeah, I think that's an interesting dynamic. It's something interesting to explore. Let's talk a little bit more about that. First of all, you mentioned kind of your retail investor versus the kind of institutional investor. Can you explain what those two things are?
So retail investors are friends, family, people that you meet at the different events that we go to, relationships we develop through referrals, those types of investors that, we go out and we raise a couple $1 million. We may have, 20, 25, 30 investors in that deal. Whereas the institutional capital, you go out to an insurance company or a credit union, someone like that, or a family office, and it's a one check investor. There's a lot of difference between the two. A lot more strings attached to the institutional capital. Give up a lot more control sometimes, depending on who that person is writing the check or who the organization is writing the check. But so different avenues, but it allows you to maybe accomplish a larger goal.
So you mentioned some of the pros and cons right there of institutional capital. And, from our perspective, and every investor we talk to, at some point, this is a conversation that they have to explore. Do you stick with retail investors, kind of your friends and family, and really raising capital one individual at a time, 25,000, 50,000, 100,000 at a time? Or do you go to a large institutional investor who can stroke a check for 7 or 8 figures at one time and, make it easy to do a deal? So you mentioned a couple of the pros is obviously the one check. It simplifies the capital raising process. And a couple of the downside elements are there's strings attached to that capital, as well as the loss of control. And what do you mean exactly when you talk about the control? What are some of the things that maybe we aren't thinking about when we talk about the control when you work with one investor versus, syndicating a deal amongst a bunch of retail investors?
Well, they're going to want to have a lot deeper dive into your business plan and may have some input into what aspects of that you tweak. They will have levers in there they can pull that can take control away from you, if need be. And that's pretty scary. Whereas with the retail investor side, the general partnership maintains all control, all decision making, and we do that as good stewards of the passive investors' funds.
Yeah, so you can get fired basically from your own deal working with these institutional investors.
Mm-hmm.
Yeah, so I mean that's definitely something to think about, and I think for every person it really depends on the longevity of how long you've been operating, the experience you have, relationships. But again, there's definitely a lot of factors to consider. One other thing that we've always talked about, and some of our operating partners we've had this conversation is, with some of these individuals, because they are taking a deeper dive into the financials, into the business plan, they tend to move a bit more slowly. So if you've got a deal and you put under contract and you've got 60 days to close, you may not even get a real firm commitment from this institutional capital until, you're much past or much deep into the due diligence period. And they may decide to pass or to walk. And I've unfortunately heard stories and know people who have been, days out from closing where that institutional capital partner has decided they weren't going to do the deal for whatever reason. And here they are now, trying to figure out where they're going to get millions of dollars to close a deal in a handful of days. So, there's definitely some pros and cons there to figure out. And I would say if you're going to go that route, definitely build the relationships. This is a relationship business, and this is no difference here. You want to make sure you get to know them, understand what a deal looks like, understand what are the things that would cause them to pull out of a deal or cause them to change the terms of a deal. And just really make sure before you even write an offer, I would be having conversations with them to say, hey, look, here's the deal we like. Here's what we're going in at. Are you guys comfortable with something like this? What questions do you have? What concerns do you have? And understand the way they'd want to structure that deal. So certainly something to consider. And I like the fact that you're thinking about adding this. It's not necessarily that you're walking away from working with your retail investors that you've built these relationships with over the years. It's more so to say, hey, listen, if we had almost essentially a line of credit of a couple $1 million to go out and do deals and to go take advantage and buy in bulk, then how do we do that? Is this something that allows us that flexibility? And I think that's a great way to think about, how do you grow, Trident Multifamily and continue to build on your portfolio?
Right. Absolutely. Yeah. We don't want to abandon our retail investor arm, and we really enjoy the relationships we've built. And that's part of the fun is getting, being able to share the wins.
Absolutely. Absolutely. So let's talk a little bit more about the markets. As you look at them right now, what are you seeing for them in the future, right? I mean, you've got three markets that are fairly different, Oklahoma, Kansas, and DFW definitely have, at different points in the cycle and different factors going into them. How do you project those markets going forward?
Well, we see, because we have diversified employment in all the markets that we're invested in, we don't see that any, one industry is going to elevate or take us down, really. So we see see steady, stable growth in those markets, and that's why we chose them. The DFW market obviously is a little bit different in the fact that it does have an immense amount of job and income growth, and we don't really see that changing all that much. It may slow a bit, but long-term projections are still pretty bullish on the Dallas market.
No, I love it. Listen, great things there. And obviously we're all kind of working without a crystal ball, but nonetheless, it sounds like the fundamentals of the markets are still sound, and you're not seeing a bunch of things that will change that right now, at least. And we'll all see what happens over the next couple of months with these companies, with businesses, with government. But nonetheless, it sounds like the fundamentals are strong. And you're trying to position Trident Multifamily to be in a position to take advantage if deals come on sale that are going to be, great additions to your portfolio. Yeah. Hey, so with that said, we're going to get ready to transition to our Bullseye Round. But before we do that, I want to make sure our listeners understand how they can get in touch with you. What is the best way to reach out if they want to learn more about Trident Multifamily or connect with you directly?
We can go to our website, which is tridentmultifamily.com, or you could follow us on any of our social media channels. We have a Trident Multifamily Facebook page, Trident Multifamily YouTube, Twitter, LinkedIn, any of those, or you can give us an email, info@tridentmultifamily.com. Reach out anytime. We love to talk real estate, love to educate people, and always looking for good strategic capital partners as well.
All right, let's jump into our Bullseye Round. Give me a failure or an apparent failure that set you up for later success.
Well, early on in my career, I was doing flips and realized it wasn't like the TV shows. You know, you don't wake up one day and things are bright and shiny and you have $50,000 in your pocket. So the thing I learned through that is A, don't take failures or apparent failures personally, and be persistent and work through these things. And I came out stronger on the other side.
Give me a book that you've recommended or gifted the most in the last year.
Probably Joe Fairless's new book, on apartment syndication. I had a lot of people that request information, and I tell them that's one of the best A to Z books on apartment syndication that there is.
Give me a digital or mobile resource you recommend for your business.
So we've implemented two recently, an investor portal, which we use is AppFolio. It ties in perfectly with our property management software, and then also to Active Campaign to be able to stay in touch with our investors.
What's the daily habit that helps you stay focused on your goals?
Probably number one is reflection and prayer time in the morning. I get up early, grab a cup of coffee, read my devotional, and just reflect on the day.
What's one thing you know now that you wish you knew when you were starting out?
That raising capital is not asking for money, it's providing opportunity.
What are you curious about right now?
What's going to happen in the next 6 months in the market? That's really the biggest unknown I think everybody's thinking about right now is what the future holds. But all we can do is control the controllables, put things in place that will help mitigate any potential risk coming in the future.
All right, Mike, we've talked about a lot of things. You've given us a lot of great information. Right now, I want to know one thing. Where is the best place to grab a bite in your neck of the woods?
Oh, wow. So many good places, but I love sushi, and Haruno is one of the best sushi places I've had anywhere in the country, but it's right here in Springfield, Missouri.
Mike, one last time, give us the best way to reach out to you.
Our website, tridentmultifamily.com. Go on there and link up with us, request a phone call, and you can actually even access coming soon our Trident Multifamily School, which is where we educate people on multifamily real estate investing from a passive investor standpoint.
Love it. Mike, listen, this has been a lot of fun, a lot of great information that you provided today. I like really hearing your story and your journey, right? It's very familiar to me, and I found a lot of similarities into it. And for you being in medical sales, you obviously had a natural network of doctors and physicians and other people who I think would fit nicely that you could help from passive investor standpoint, but really understanding what layoffs and going through that process and, having to self-reflect almost every time this comes up and saying, hey, are you really doing the best thing to protect your family? What other things can you be doing to, put them in a great position financially? And then how can you serve other folks? I love listening to you talk about the way you approach investing with your investors, because it's less about you raising money and you going out there and asking people for money. It was more about how do you serve them and create an opportunity for them to do the same thing and take some of the same advantages, both from a cash flow standpoint, the tax benefits that are prevalent, as well as just diversifying the portfolio. And the way you approach those conversations, I think, was very insightful. I loved hearing you talk about your partnerships, the way you guys look at the 3 different markets that you focus on, and how you're looking to pivot coming out of COVID-19. So lots of great information. This has been a lot of fun. Good talking to you, and we hope to stay in touch and see you again soon.
Absolutely. Thank you very much, John.